You walk into a dealership to buy this car. $30,000. Same model. Same mileage. Same afternoon. At a credit score above 780, the finance office may see a customer that several lenders want. Around 700, the deal is still ordinary, but the first interest rate placed on the desk may not be the lowest one available. Around 630, the conversation begins drifting away from the price of the car and toward one question: what monthly payment can you handle? Below 600, the lender may start influencing which car you can buy, how much cash you need, and how long the loan can last. At the bottom of the scale, simply obtaining an approval can become the product being sold. The car never changed. The price of the money did. And that difference changes how much power you have in the room. The score you see may not be the score they see. First, there is no single universal credit score sitting beside your name. The score in a consumer app may use a different model, a different credit bureau, or data captured on a different day. Auto lenders also frequently use industry-specific scores designed to predict the risk of an auto loan. Base FICO scores generally run from 300 to 850. Some industry-specific FICO scores run from 250 to 900. So when a buyer says my score is 720, and the dealer produces another number, that difference is not automatically evidence of deception. But the number is only the beginning. Lenders may also consider income, existing debt, down payment, the amount borrowed, loan length, the car's age and mileage, and the relationship between the loan balance and the vehicle's value. Think of the score as the first gate. Everything behind it decides the shape of the deal. 781 and above, they compete for the loan. At the top of the scale, financing becomes less about finding any lender and more about choosing among lenders. The customer is more likely to qualify for competitive bank, credit union, or manufacturer-backed offers, assuming the rest of the application is strong. A large down payment may improve the deal, but it is less likely to be the only thing holding the approval together. This customer can separate the negotiations. First, the out-the-door price of the car, then the trade-in, then the financing. And if they arrived with a pre-approval, the finance manager has a number to beat. That does not mean the dealership stops trying to make money. It means the opportunity moves. The conversation may turn toward an extended service contract, gap coverage, appearance packages, wheel protection, or another optional product. Excellent credit reduces the price of borrowing. It does not make every item on the contract a good deal. 661 to 780. Approved, but at whose rate? This is the broad prime range. Many borrowers here can receive conventional financing, but approval and best price are not the same thing. When a dealership sends an application to a lender, the lender can return a proposed interest rate, the buy rate. The dealership may present that loan to the customer at a higher rate and earn compensation from the difference. That means a friendly sentence like, "Good news, we got you approved," leaves out the most important question. Approved at what rate by which lender, and was there a lower offer? The rate is negotiable, but a customer who negotiates only the vehicle price may never realize that the financing changed behind the desk. At this score, the dealership may treat the transaction as routine. Routine is comfortable. It can also make the customer stop checking the arithmetic. 601 to 660, the monthly payment trap. Now the number of comfortable approvals may shrink, and the deal becomes easier to sell through a monthly payment. Suppose the customer says, "I cannot go above $600. The dealership can lower the payment by extending the loan, increasing the down payment, changing the vehicle, or rearranging products inside the contract. Only one of those options necessarily makes the car cheaper. This is where 72 and 84-month loans become powerful. The payment fits, but the customer remains in debt longer and may pay far more in interest. Experian reported that in the first quarter of 2026, more than 35% of new vehicle loans and more than 31% of used vehicle loans lasted longer than 6 years. The question, "What payment do you want?" sounds helpful, but the number that protects the customer is total cost, the amount financed, the annual percentage rate, the loan length, and the sum of all payments. 501 to 600, the lender begins choosing the car. In the subprime range, a salesperson may still find an approval, but approval can arrive with conditions. The lender may want more money down. It may limit the maximum payment compared with verified income. It may reject a car that is too old, has too many miles, or is priced too far above its lending value. It may require proof of income, proof of residence, references, or a cosigner. At this point, the customer is no longer choosing from every car on the lot. They are choosing from the cars that can fit an underwriting box. And because the base payment is already expensive, optional products become even more consequential when financed. A $2,000 add-on does not remain a $2,000 purchase. Interest follows it for the length of the loan. The risk is not merely a higher rate. It is allowing a complicated approval to make the entire contract feel non-negotiable. 300 to 500, approval becomes the headline. At the deepest end of the credit spectrum, mainstream financing can be difficult, though a low score does not produce the same result for every person. A large down payment, strong provable income, a less expensive vehicle, or a qualified cosigner may change the application. Specialized subprime lenders or buy here, pay here dealerships may also offer paths to a car, often at a much higher total cost. The emotional pressure here is different. A buyer may need transportation immediately to keep a job. After several denials, an approval feels like relief. Relief makes it harder to inspect the details. Is the financing final? Is the APR the same one discussed earlier? Were optional products added? Is there a prepayment penalty? What happens after one late payment? Can the customer afford the insurance, maintenance, fuel, and repairs after making the loan payment? The most expensive deal can feel like the only door still open. What the dealership is actually negotiating. A financed car purchase often contains 4 separate transactions: the price of the vehicle, the value of the trade-in, the price of the loan, and the optional products sold in the finance office. When all 4 collapse into one monthly payment, movement in one category can hide profit in another. A higher trade-in value can be offset by a higher vehicle price. A lower payment can be created by a longer term. A small add-on can disappear inside 6 years of payments. This is why the customer's power does not come only from having an excellent score. It comes from keeping the 4 transactions visible. How to change the room at any score. Before visiting a dealership, review your credit reports and identify errors. Then seek a pre-approval from a bank, credit union, or another lender. It establishes a rate and budget before the sales conversation begins. Credit scoring models generally group auto loan inquiries made within a limited shopping window, often between 14 and 45 days, so comparing lenders does not necessarily mean taking a separate scoring penalty for every quote. At the dealership, negotiate the out-the-door vehicle price, not merely the monthly payment. Ask for the APR, amount financed, loan term, finance charge, and total of payments. Treat the trade-in separately. Decline optional products you do not want, and confirm that the financing is final before assuming the deal is complete. Most importantly, preserve the ability to leave. A credit score changes what lenders are willing to offer. Urgency changes what a customer is willing to accept. The dealership has the most control when it controls the car, the financing, the trade-in, and the clock. Your score may determine the price of money. Preparation determines how many other prices remain negotiable.